Welcome to the State of the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And our very special guest is Daniel Bird. Daniel Bird, welcome to the show.
Thank you. Thanks for having me.
Great to have you on. I'm really excited because you're going to be speaking about an area that I don't think we've had anyone on talking about before, which is distressed debt. And I'm particularly keen at some point to get into how it has a predictive element of the stock market potentially, and where we should be looking at this, because I know very few people will be looking at this area. But before that, we'd love to know more about you. Tell us about your journey and how you got involved in the financial markets.
Sure, no problem. Thank you. Great to be here. Distressed debt is kind of a niche in financial markets. That's one of the things that probably attracted me to it. It wasn't as crowded as some of the other places in markets. But how I got involved in it, I've always kind of been in finance, involved in debt. So my first job was at Credit Suisse back before the DLJ merger in the 90s. Doing leveraged finance and corporate banking. That was mainly high yield bonds, leveraged loans, things like that. From the origination side, helping sponsors buy businesses, monitoring a portfolio that Credit Suisse owned of those loans, that kind of thing. While I was there was a group that was trading these loans and these bonds. It was run by a guy called David Matlin, who went on to found a fund called Matlin Patterson, with another guy from Credit Suisse called Mark Patterson. And that's how I got my first intro to it. Whilst I was doing these deals from the origination side, I looked over across the floor and saw these guys, who were trading this debt, and thought that was pretty interesting. So after Credit Suisse, I went to graduate school at Kellogg in Chicago, and then I joined Merrill Lynch in London to do distressed debt. At that time, the European market for distressed debt was very small. It was only a couple, pretty large capital structures, Eurotunnel, for example, and a couple others. So it was really at its infancy.
Sorry to cut in, Daniel, what is the definition of distressed debt?
So distressed debt, it has many. It has a lot of different definitions. I think the word distressed debt technically means debt that trades at 1,000 basis points or 10% over, base rate. That's a very loose definition. I don't necessarily think that's always the relevant metric. There are a lot of performing debt deals out there that yield above 1,000 over. So
presumably something that's trading a significant discount to par would typically qualify.
Yeah, it all depends on coupon and things like that. You could have something with a 10% coupon that trades in the 90s and still is 1,000 over on a spread basis. But I think a lot of people have moved away from distressed debt, and most people use the term special situations now, which encompasses a little bit more than just distressed debt. I think distressed debt experts, you develop a lot of expertise in corporate capital structures and structured credit capital structures. So within special situations, there's distressed debt, there's recapitalizations, there's capital solutions, rescue financing, DIP financing, lots of things like that. Sometimes growth financing in some technology companies or healthcare companies. So it's become a little bit more than just companies that are in trouble, if you will.
And you say companies, so presumably distressed debt is typically a corporate structure as opposed to sovereign issue debt.
Sometimes I think sovereign sometimes gets caught up in the distressed universe. Typically emerging markets or frontier markets or whatever you want to call them now, get in trouble and sometimes have to restructure. So that encompasses that as well. So anyways, back to my story. So I joined, that back in 2000, I joined Merrill Lynch, which then became Bank of America. Spent, majority of my career there running what we called global credit and special situations. It was the team in London, and we grew with the market. Turned out to be great. We looked at special situations and distressed debt, throughout Europe and into the Middle East sometimes. The global financial crisis obviously provided a lot of opportunities across jurisdictions and across sectors. Corporates, real estate, infrastructure, there was so much to look at. Those were interesting times. Returns were amazing, and for the 10 years after the global financial crisis, in a lot of different places. That led to, I think, was just before the growth in private credit, which a lot of distressed and special situation investors have kind of morphed into private credit type investors now. So that's kind of how the market's moved on. And I would consider myself a little bit broader than just a distressed debt investor, more of a special situations, private credit, capital solutions type investor now.
Bring us up to date now. You are an investor, or you're an advisor, or both?
Yeah. So like I said, Merrill Lynch and then Bank of America, I spent 20 years there. I worked at a fund in London called Hayfin Capital. That was mainly a private credit business, direct lending business, but it had a special situations fund within it. I was there for a couple of years, and then I set up my own company called Thornwood Capital to take advantage of opportunistic credit opportunities in Europe with a small team. The first transaction we did was to purchase a portfolio from a European bank of largely corporate distressed and kind of stressed loans and bonds. There was some reorged equity in there, some other bankruptcy type claims in there, some DIP financing in there as well. That was back about a year and a half ago. So that's what I'm doing now, running my own company called Thornwood Capital.
So how do you differentiate between looking at a company that's got distressed debt that's going to go completely bankrupt and one that's an investment opportunity?
Yeah. I mean, that's kind of that's the art of it, I guess. Yeah. I think look, the bankruptcy. I think a lot of people think bankruptcy means the end of a company, and it's just not the case. It just means that they have too much debt. So most of the companies we go through, their life doesn't end. It continues to go after they restructure their balance sheet. They write off a certain amount of debt. They get some new money to do different things that they need to do to survive. So it's not necessarily looking at a company that's going to end and cease to exist. It's more looking through a potential restructuring and what needs to happen, and evaluating if it's a good investment to buy the existing debt. Like I said before, distressed debt or opportunistic credit sometimes trades in 90 cents and sometimes trades at 5 cents. It really depends on the change or the process that the company or the entity is going through. You have industries that change very, very rapidly. You can take I think one of the most famous ones in Europe over the last 20 years has probably been the Yellow Pages business, for example, where everyone used to get a big fat book in their mailbox of listings for businesses and things like that, and guess what? Google killed that a long time ago. So a lot of those businesses, the debt was very impaired given the how those businesses shrank over time, and the debts there traded in the single digits at some point. Right. There was a part of that business that survived and probably got bought by some other type of media company. So they did survive, but that was a severe distress situation. Contrast that with something that goes through a period of distress and emerges sometimes stronger. So during COVID, we were very active in companies that focused on events, so conferences and things like that for a variety of different industries. Obviously, when people were in lockdown, no one was going to conferences, so revenue went to zero. But that only lasted a couple of years. So investing in those companies was figuring out how much cash burn there was going to be during the time of COVID lockdown, and what the business was going to look like after it emerged. From that period of lockdown, how long lockdown was going to be, how severe, what people's appetite for going to conferences would be, coming out the other side. And a lot of those businesses returned to where they were and are probably bigger and stronger now. So that those two different sides of the coin between directories and the conference businesses.
For fans of Wall Street, the original Wall Street, remembering how they buy companies that are distressed and then break them up. That's not quite what you're looking to do.
Sometimes it is.
Oh, okay.
Sometimes it is. Look, I think one of the interesting things about distressed debt or special sits or opportunistic credit, whatever, is that there are so many different routes to take. Sometimes the most appropriate thing is as you say, here's a company it's a conglomerate, it's got 5 different businesses. The debt trades at a level below par that yields something worthwhile, and the market is kind of undervaluing the sum of the parts of that business. So sometimes the right thing to do is to buy that debt, and hopefully agitate in some way for change where the business gets sold off in pieces, or some of the pieces get sold off in order to reduce debt and put the company into a better financial position. Sometimes that's the case. Sometimes, like the example I spoke about in conferences, it's just riding through a period of lower revenue. So there's various things that can happen where you can make money. It's not always just breaking things up. It's not always just waiting. Sometimes sometimes you need new money to invest in a new project, right? If you're a real estate company, for example, and you have an old building, sometimes you need new money to do a refurbishment. And after you do that refurbishment, you have a building that yields a lot more than it did prior to that. So there's a lot of different ways to make money, and evaluating all of those different paths, I think, is the fun of the type of investing that we do, and also the art.
So if you've got, let's say, the simplistic case of a bond that's trading at, say, 90 cents on the dollar, and you're looking for it to basically redeem at par, that implies something like a 10% return. Does that mean that you're often using a lot of leverage with these deals?
Some people, a couple different ways to talk about leverage. First of all, there's leverage in the investments that you're making. So, the company that you referenced where the bonds are trading at, 90 cents, that might be a very levered company. So that might have debt that's 8 times the value of cash flow, for example. So that's a leveraged company. Those typically the situations that we get involved in have significant amount of leverage in them. There's also you can leverage your investment. So if I buy the debt at 90 cents, maybe I borrow 50 cents to buy that debt at 90 cents, and I only invest 40 cents of my own money. So both, you have to evaluate both things when you're looking at these investments. The leverage in the entity that you're investing in, and how much you want to leverage your own investment.
Sounds like you need to be something of an accounting expert to get into this business.
People come from all walks. I think a lot of the original distressed debt investors were probably lawyers, where they were looking at hard bankruptcies and liquidations and things like that, where knowing the legal process and how to get information out of a legal process was very important. I went to university and studied accounting. I'm a CPA. So that's helped me, I think, along the way, knowing how to look at balance sheets and companies, and and get deep into what was really going on in a company. So there's all different approaches. Sometimes management consultants are quite good at distressed debt investing because they understand business models and what it takes to turn around a business model or change a business model in order to make it a little bit more robust. So lots of different skill sets are needed to look at some of these investments, but people come from all walks.
Just thinking about how markets or companies, when they go into bankruptcy and it's not necessarily the end, am I right in saying that Lehman's is still technically, it still technically exists, but obviously it's not tradable?
Yeah, well, I think the entities that some entities from Lehman got bought, right? Into JP Morgan and things like that. So, I think the entities that remained outside of those acquisitions, I think are now defunct. I think all of those claims are now repaid. I'm pretty sure about that.
Okay.
But that's a very, very complex situation. Obviously, hundreds and hundreds of legal entities, various different borrower levels, different rights for different types of creditors. That was a full-time job for many people for, largely 10 years after the bankruptcy of Lehman. A lot of guys made a lot of money on that, which was good, I guess, but not so good for the people that worked at Lehman.
Yeah.
But yeah, that one's largely done.
Yeah. So the ethics how people view that is like that. I put that to one side because, there's businesses that do all sorts of things. As long as the market's efficient and legal, I think everything's pretty much fair. And, I use the Wall Street and, example, thinking about that, it might have come across as though that was like, it wasn't supposed to be a derogatory term for what happened, although in the film it was seen like that from the Michael Douglas character's point of view. This is the efficiency of the markets, even though it didn't really help the people who work for the company. But that brings me on to where we have been over the past 10 or so years with interest rates, or even more, with interest rates at low levels, where companies that normally would have kind of fallen out of the system have kind of continued on and being able to trade, but not actually, like, kind of ended up as a zombie company where it should either have gone one way or the other. The dead wood should have been cut away and a new business started rather than it kind of overhanging the system. How have interest rates affected your business and your opportunities? And how do you view companies like that that seem to be stuck in this kind of twilight area?
Yeah, I mean, it's a very complex answer, I guess. And I hate to be one of the people that answers this, but it depends, right? I think, look, rates were very low for a very long time. 2022, was a real awakening for people, right? And interest rates spiked, given inflation, all of that kind of stuff, and a lot of corporates, came under a lot of pressure. Look, it led to a lot of restructurings. It led to a lot of refinancings. It led to a lot of deleveraging, meaning new equity coming into the business to pay off debt. Some things went bankrupt, of course, right? I think when you look at all of these companies, like I said, you have to look at them through different lenses. So, for example, some of these zombie companies, you'll say, well, they're borrowing at such a low rate that they don't care, if they have too much debt, because they're not going to default. Their debt is so cheap; they only cost 1%. They can live forever with that balance sheet. Sometimes that's a pretty good investment, depending on where the debt trades, right? So, if you have a bond or a loan with a 1 or 2% coupon, I mean, you're not going to buy that at par, obviously, because you can buy government bonds at 4 or 5% now, right? So that's gonna trade on a market value basis, somewhere below par. So maybe that trades at 70 cents, so 80 cents, something like that. Some people, and the yield on that will be, I don't know, 7 or 8%. Some people might view that as a good investment. What's wrong with 8%? They're going to get that until the debt matures, and they just kind of sit there and clip their coupon. Maybe they put some leverage on it to make it a little bit more attractive, and like life goes on. Some people will look at that and say, no, there's too much debt. It's going to have to restructure. I'm never going to get back all my money, the par value of the bond. So they have to, they model that into their scenarios and what happens over time. Maybe at maturity, there is a restructuring where some of the debt gets written off and you don't actually return, what you expect to get. So there's various lenses you have to look at these things. But what it generally means, and I think there's been some relatively public portfolios out there that have been impaired significantly on a mark-to-market basis because of the rise in interest rates in 2022. I think Bank of America had a pretty significant mark-to-market loss on their investment portfolio in fixed income. They decided to go increase duration on their on one of their investment books, and it resulted in a paper loss of billions and billions of dollars. So when interest rates change like that, it obviously has an impact on the market value of assets, but also creates opportunities.
I suppose one of the key differences between the bond market and the equity market is that there's a lot more retail participation in equities because the typical ticket size is quite low, whereas in the fixed income market, typical ticket size is quite high. So presumably this is a mostly, if not exclusively, institutional market. What kind of investors are typically trading or investing in distressed debt?
So the first part of your statement, absolutely, it's generally not a retail market. There are very big liquid structures that sometimes people participate in the retail sector. So Lehman, for example, people could have done, but quite a complex situation. So a lot of work to do as a retail investor for that. So yeah, mostly institutional investors. Look, there are specialist funds that focus on distressed debt, special situations kind of investing. Some of the big kind of private capital U.S. funds, were pioneers in this. So that's the Apollos of the world, the Oaktrees of the world, Cerberuses of the world. They've moved on and expanded their businesses to be much more than that now. But there do remain, niche, investors that are focused on this space almost exclusively, opportunistic credit or private credit, whatever you want to call it. In Europe, that's people like Attestor, like Fidera, like CrossOcean. These are not probably household names to you, but in our market, they are they're very relevant players. It's not an enormous market. I think funds that really specialize in this alone, tend to be kind of smaller than 10 billion, versus an Apollo or a Blackstone or something like that, which is hundreds and hundreds of billions. So it's still a little bit of a backwater industry just because of the nature of the product.
So is part of your strategy to buy lots of distressed debt and then the ones that work really outperform, or do you have some type of risk management metric that deals with what you buy and how much you can invest?
So I think if you're talking about kind of the institutional market, investments usually get written on an investment by investment case basis, right? So we invest in each situation with a view to making money. It's not necessarily like a venture capital type thing where some make money and some don't. Not everyone's perfect, and sometimes you lose money on things and make mistakes, and like that just happens. But for the large part, people are underwriting individual investments. There are parts of the market that are slightly different. So, for example, post the global financial crisis, there was a lot of stress in household balance sheets across Europe. So there's something called non-performing loan portfolios. These are typically owned by banks or bank-like companies, maybe in credit cards or things like that have exposure to either very small businesses or retail. And those tend to trade in pools. So you might buy a non-performing loan portfolio with a face value of 500 million for 250 million, so a 50% discount, and that might be a couple thousand claims in there. And those situations you underwrite on a mathematical basis. You apply recovery rates to each one of the claims in there, depending on size, depending on jurisdiction, depending on age, etc. And that's how you get your return. And there, yes, you'll have some winners, some losers, but overall as a portfolio, you hope to make money.
It would be great if you could give us an example of something that you identified and then invested in and how it worked. If you could give us one that worked really well and one that didn't work so well and why on both sides, that'd be really interesting.
Yeah, sure. We've had a pretty buoyant market, since kind of the COVID turnaround. So there haven't been a ton of, really, really amazing things recently. But I think one thing that might appeal broadly to the investment community is FTX. So that was the crypto exchange that was founded and owned by Sam Bankman-Fried, who's now in jail, I believe.
Yeah.
And there's actually a book about it. It's a Michael Lewis book about it. Quite a good book. And
great writer and crazy story. Yeah.
Yeah. Great book. But if you read that book and you follow that situation closely, this guy Sam Bankman-Fried, he was investing in all sorts of tech and VC and things like that. Even things like OpenAI, I think he invested in, right? And though there's claims for FTX, there are debt claims and people who had crypto that they thought were that had value in the FTX structure, that traded at cents on the dollar, right? It was very, very hard to figure out what was in there, to figure out what they were worth. But it turns out that guy was probably pretty good. Either he was good at evaluating some of these tech opportunities, or he was just extremely lucky in timing, because a lot of those investments turned out to be wildly fantastic. So I think a lot of those claims that traded at sub 10 cents, sub 15 cents were ended up being worth more than the 100 cents. So that's one that I think is very interesting. So what did it require to do that trade? First of all, you had to focus on it. Second of all, you had to know how to deal with acquiring information, getting information from the bankruptcy court, from the bankruptcy attorneys, going through reams and reams of financial disclosures from FTX, picking out investments and where you thought those investments were, and what where those investments the value of those investments flowed. Quite a complex thing to do. I know there's a few people that I know here who really focused on FTX and did extremely well buying claims sub 20 cents and ended up being greater than par. So look, the point there though is that it's just about work. It's just about rolling up your sleeves and looking at every piece of information you can about FTX to try to piece together what the valuation was. A lot of the valuation did relate to some of the investments that this guy made that were wildly successful. So figuring out what those were, how much they were worth or could be worth, was a really amazing thing. I doubt that everyone thought, at that point in time, whenever people made those investments in the, earlier in the decade, that we'd have the AI explosion like we have the last 2 or 3 years. So maybe they were buying things at 20 cents, hoping they were worth 30 cents or 50 cents. But the valuation of the underlying investments just turned out to be so great that it was a total home run for people.
So did you have a look at it? Was it something you were looking to invest in?
That's not something I looked at. I looked at it briefly and thought there was too much crypto risk, and I just didn't have the expertise in crypto.
That seemed fair given where it was. Yeah.
Yeah. And so I decided to pass. I think you can't do everything. And at that point, I just didn't have unlimited resources to chase after it for 2 years. But the guys who stuck with it, I think did very, very well.
You may have answered the question already just now, but are there any kind of industries that you would shy away from on the basis that it's either too difficult to assess or too opaque in accounting or things like that?
Well, I mean, crypto still to me is pretty challenging. It's hard to value the cryptocurrencies themselves because they don't have any cash flow value. I
to give you an idea, I was at an investment conference in Las Vegas, probably getting on for a decade ago, and one of the speakers was a guy who was a dedicated short seller in equity, in equity land, and he said that one of his favorite sectors to short was basically restaurants.
Was that Evel Knievel?
Say again?
Was that Evel Knievel?
No, he's an American investor.
Oh, he's an American guy. Okay.
And he was saying that he likes the restaurant sector to short because most of the profits tend to walk out in the staff's pockets. People have a tendency to get sticky hands. Yeah. And so his favorite strategy was basically to see what he described as a small wounded animal by the side of the road and then run it over a few times.
Funny. Look, I tend to be pretty open-minded as I can, and I can tell you a story about the restaurant industry, which I made money on, and it's kind of the reason I try to not say no wholeheartedly to things. There was a restaurant chain in the UK, in the Italian restaurant space. They had high yield bonds outstanding, various different levels of high yield bonds. It was a tough story, lots of competition in the space. I mean, pretty easy to set up an Italian restaurant chain, changing appetites from consumers in the UK. It was very, very difficult to see a path forward in terms of, that company recovering to where it once was. However, part of the analysis that we do is a legal analysis and what claims you have and what rights you have as a bondholder or a loan holder at various different levels. So that's a situation that had senior debt and junior debt. We knew that the junior debt had the ability had a right to vote on a restructuring. So we thought this company wasn't going to go away, it wasn't going to liquidate, it was going to restructure, it was going to continue as a going concern, which it did. And we thought the junior bonds that they had the right to vote. So they had a little bit of what we call holdout value or hold up value, where in order to get them to vote for your plan as a company that wants to restructure, you have to give them some value. So when the situation like finally blew up, when everyone knew it was going to restructure and debt traded down significantly, we bought some of those junior bonds thinking that we would get a vote at the table and we get some value because of that vote, and that's what happened. And we made 2 or 3 times our money on that. So like I said, it's hard to turn away everything, but I think if you're building your portfolio around asset light type businesses, meaning retail or restaurants or things like that, it's pretty hard because all the things you said, Tim, are true. Your assets walk out every day, and what's left, kind of thing, right? I think there's a lot of private capital that's flowed into software and technology in recent years, in the last 5 years, let's say. Not all those businesses are going to survive. A lot of those could be binary. I think particularly what's going on with AI, a lot of software itself could be, redundant, right? So there's going to be winners and losers in that. So picking your spots and, making sure you have diversification in your portfolio, I think is terrific. But most very, very traditional distressed debt investors will say they only invest in asset heavy industries, right? So real estate's probably the best example where, you have a building or buildings and you can value those assets relatively straightforward, and the range of values around that asset are very, very, very small. It would be great if you could construct a portfolio around 100% businesses like that, but you rarely can.
It reminds me of an old a great Dilbert strip from back in the day, and I think the curly head boss says, but I know we've said for some time that our staff are our most important resource. But we've done an audit and it turns out it's actually carbon paper.
Nice.
So thinking about the valuation of companies, there are times when you mentioned real estate. There are times when retail companies' valuation is less than the value of their real estate. Is that something that you identify as an opportunity and may want to buy into the company for the real estate portfolio?
Yeah, absolutely. I think you have to look at those situations, through various lenses, right? So I think there's a chance that the market's right and the operating company doesn't make any money and doesn't have a future, and therefore the only value that you should attach to is the real estate value, and you'll make a judgment based on the specific facts of that case. Whether you want to buy the debt or the equity in that, depending on valuations. There are some times where the market's wrong, and there are certain operating companies that the market's valuing at zero that are in fact worth something. So it really depends on your valuation and your view. Look, the retail space changes a lot. I mean, department stores in the U.S., for example. They're hard to value. They're hard to put a lot of value on these things because they just don't make a lot of cash flow.
Like Bed Bath and Beyond.
Yeah, exactly.
That went bankrupt during a time when you've got a real estate boom, which is quite unusual, I would have thought.
Yeah, well, I think they leased most of their stores. They didn't have a lot of real estate value. So
yes, but for what they were selling, I would have thought it was more conducive to it's not like it was a recession and people weren't spending money. I mean,
but that's like, to go back to Wall Street. That's like him saying that, Jesus, if this guy was an undertaker, nobody would die.
Yeah. So
I don't know Bed Bath and Beyond, very well. I don't think there was a lot of real estate value there, but I don't know.
Yeah.
But again, I just think that business model had its day, and I think it just got outcompeted. And these big box stores for a very narrow product range. The internet killed it, Amazon killed it, whatever you want to call it.
Yeah,
Toys R Us is the same.
I was going to say
Amazon killed Toys R Us.
I was going to say Toys R Us. I also think, I don't know. Well, actually, there is an example of a company sector that I think is going to be under a lot of pressure, and I just wondered, before I mention what I think it might be. Are there any that you've identified already that you kind of earmarked for these businesses are on borrowed time potentially? And we all know that nobody knows everything, right? So just potentially, are there any sectors that you think could come under pressure in the next, say, 5 to 10 years?
I think I don't have a long list. I'm not really a short seller, if you will. But I think the one industry that's screaming at me is the automotive industry.
Okay.
I think that is just getting re-racked really, really in a big way. The competition in electric cars coming out of China, and other jurisdictions is significant. I sit here in the UK, and there's a new brand of electric car every week or every month here that I see. What is that thing, right? And they're good value for what they are. They are taking market share. So I think companies like Stellantis and some of the other smaller guys, I think they're going to come under significant stress. That also means that a lot of the suppliers to the automotive industry are going to come under stress, right? A lot of small companies in Germany, for example, could see some significant stress. So any industry that's going through change like that, is a good target for kind of for monitoring the things that I'm talking about.
So mechanics and automotive shops.
Yeah, I also think automotive dealerships, right? I think I have a few friends from the US that are in that business, and if you break down their profitability as a business, as a local business, they make X amount of money selling new cars, they make X amount of money selling used cars, they make Y amount of money in their shop, right, doing repairs. And these new cars, these new electric cars, they just don't have repairs. They don't have the same amount of maintenance required to them. So
absolutely. Yeah.
If you it could be for a lot of those people, if you take away that the repair shop business, maybe the company doesn't make money.
I mean, an electric car, all it needs is you change the brakes, you change the wheels. I suppose the kind of windscreen wash, and that's pretty much it.
Yeah, you don't have all of the different things, right? The transmission, the engine, the carburetor, the whatever. I'm not a car expert, so the things that could go wrong are very simple to fix, except for the battery, of course. But I think battery technology is getting better and better and better. I think that will continue. So anyway, I don't know the details for the big car retailers in the U.S. or anywhere else for that matter. How the profitability breaks down between the different types or subunits within those businesses, but there could be a place for some stress for sure.
So I was thinking about there's a company that buys up very awkward real estate plots in prime locations. So there's one in the city. I think it's on Blank Street, if I'm correct in the name, but I could have got it wrong. But anyway, it's a kind of an AI robotic coffee shop. So it's now, instead of having 5 or 6 employees, it's got 2. So it's gone right down. It's far more efficient. And I think that this is, unless Starbucks and Caffè Nero, we know Caffè Nero is already under pressure, can't make money. That's an overbanked market. It looks primed to come under a lot of pressure in the coming years, unless they switch their model pretty quickly. So they could, I think, potentially be caught out by fast-moving smaller companies. But I guess they're big enough to buy them out or just to rip the technology off. So they say that if the rate of change outside the company is greater than the rate of change inside the company, that's when you got a problem.
Yeah. That's probably a good way to think about things. I think. I mean, I haven't spent much time on the coffee shops industry. I do know that Starbucks is a very profitable business. I think their business model is getting challenged now by lots of different competitors, Pret and Luckin Coffee and places like that. And the traditional guys like Nero, I think they have some thinking to do about what their shops actually do. But
also in a cost of living crisis, coffee looks, premium coffee looks like a bit of a luxury.
Definitely.
Yeah. I agree. that being said, I don't see many coffee shops closing.
Right.
You know?
Yeah, and I guess the other one is cinema chains, because that model is very, very, it's changed a lot, and it's very hard to get people to go to the cinema these days. I mean, going back to when obviously I'm of a certain age, and the only way to see James Bond film was at Christmas, and the best way to see films was to go to the cinema. And it was a golden era for cinema, I guess, in that regard. But now
that's a little bit like the Yellow Pages example that I brought up at the beginning. And there's permanent change there. That's not going to bounce back. There's some companies that have been in the distressed debt market for a number of years now. I've always thought I just can't see the bottom. I don't know where it stops in terms of how infrequent people go to movies. I've got 2 kids, they're teenagers, they don't even watch TV. Forget about movies. They don't even watch TV. And I asked them the other day, like, if you had to go buy a house now or buy a flat now, would you get a TV? And they would say probably not. Because they're all on their phone and iPad, and that's all they need, right? So, like I said, I can't see the bottom there. So I don't think something like that is a really good investment unless it's some sort of real estate play where there's an alternative use for the theaters.
Well, real estate is really expensive. It must be very hard to monetize it, and people, especially in the cost of living crisis, and they're used to paying monthly for something that they eventually know will come on the small screen anyway.
The opportunities that I've seen, it's just not cheap enough to take that risk. So
definitely.
So I've stayed away from that type of stuff. But
well, it's also part of the problem with that is it's far more complex than I realize anyway. I mean, when you start saying, let's just do this, let's just do that, you end up with the cinema chains have got their contracts with the film companies, and they might not be able to show certain films. They might not be able to get the rights or own something or give something away or whatever it might be. And because everybody's protecting their margins, they're not wanting to work together. They're just becoming more kind of insular in their own protection. So they're not thinking about the wider picture of how everyone's integrated. So I think you're absolutely right. It's got to correct a lot more before there are some big changes. But with regard to that, looking at changes and looking at the future, there's a couple of things I wanted to ask you about. First off, given that we've seen the financial crisis of 2007, 2008 and the run up to that must have been an incredible period for you, looking at how debt was distressed leading up to it. My first question is, what were you seeing in the lead up to it, and were you aware of how unprecedented it was? And secondly, what could we be looking at in the future that could tell us we are closer to that position again?
Sure. Look, I think the markets that we look at in terms of sources of opportunities, it tends to be the leveraged finance market, right? So that's high yield bond market, that's the corporate bond market, real estate bond market, leveraged loan market. 2007, they were going gangbusters, right? It was very, very strong. People were in the equity market ignorant to the red flags that were out there.
What were the red flags?
Well, I think there was a subprime real estate crisis in the U.S. that there were some red flags. I think there were some Lehman funds that were very topical in 2007, and they actually had the right trade on. Surprisingly enough, they were short subprime. They had the right trade on. They just didn't get the timing right, and they got kind of squeezed. And that was kind of the beginning of how
they got squeezed out of it.
Yeah, that was the beginning of how kind of Lehman, started to unravel a bit. I mean, markets were very strong in debt. No one was forecasting, GFC. A few guys were, obviously. You can read the book The Great Short, things were very robust. We didn't. It wasn't like we were looking at the earnings of our portfolio companies and saying, in 2007, we weren't saying, oh my God, everybody's earnings are going down. What's happening? Right? It wasn't like that.
Right.
I think the GFC, it was everybody was kind of caught up in the bullishness.
But I was looking at the time when I was working for an investment bank, I was looking at short-term interest rate futures, which showed a lot of pressure between the banks. I was watching at bank stocks that were going down quite aggressively, started going down about a year or so before, and credit default, CDS credit default swap prices for government debt was blowing out, and all those things.
It depends on what time period you're talking about, right? I think
that was 2007.
Yeah. So I think 2008 was when it really kicked off, right? 2007, there were a lot of warning signs. Things started to move for sure. People liquidated portfolios. 2007 was definitely the start of it. I'm saying leading up to that in 2006, were earnings just coming apart? Like no, that was it was very strong.
But did it look crazy to you? Did it look like this is getting too much? Like, I mean, we know anecdotally. I mean, I know because I worked as a mortgage officer in the 1990s that when you were assessing somebody for a mortgage, you would get 3 times their income and take away all their debt, and that's all you would lend them. And then in 2005, the banks were lending, or whatever, 2006, the banks were lending 110% of the value of the property, plus they didn't really care what you were earning. And it's like, okay, this is going to end in tears.
Well, and that was ninja loans, no income, no job.
Exactly.
Loans, self-certify mortgages. And what I find particularly moving is that when I was growing up, when I was a kid, my mum would say, well, this is how it works. If you're really well behaved and the bank manager likes you, then maybe at some point you'll qualify for a mortgage. And you get to like 2007 and people's pet cats are being offered mortgages. And
literally, that's not even a joke. They weren't they? There was, Yeah,
no, I think, irrational exuberance, right? That was probably the way to think about it. That's a term from the late 90s, obviously, but
Greenspan.
I mean, that's the real precursor, right? When it's too good to be true. Everyone during those periods in 2006, everyone's like, this time's different. It's not an internet bubble. It's all good. It's all good. People were believing it, drinking the Kool-Aid, whatever you want to call it.
So do you sit on your hands at that point? Is it like because there's nothing distressed at that point? Are you just like keeping your powder dry, waiting for the opportunity to move into distressed or special situations?
So first of all, like there's always something to do in distress, right? So somebody's always messing up, right? So
okay.
Somebody's over-levered, somebody does something wrong strategically in their business that needs to be fixed. Like there's always some things to do. When spreads are extremely tight, like they were in 2006 and the beginning of 2007, or like they are now, you still have to invest, you still have to make money. So what do? You tend to shorten your duration. You invest in things that have really solid events. Maybe you take down the risk instead of, going for the thing that, it could be a 0, it could be 25%. You stay away from that and invest in something that has, a little bit tighter return perspective, but not as high. Usually that's the same thing as kind of limiting duration. You tend to invest in things where you're very, very confident in asset values that underlying the investments that you're making. So you pull in the reins a little bit. You try to, but again, no one ever knows when when everything's going to go the other way. I wish I could say now when other things are going to go the other way. So you tend to do your best to risk manage and be cognizant of what's going on in the environment and not take too much crazy risk. There were people who took crazy risk, right? I mean, Lehman and Bear, like they were taking crazy risks. They were too levered as institutions, and they kind of came apart, right? But yeah, I mean, you try to do your best to risk manage, but you never know where you are in the market exactly.
So you look at the market from an individual opportunity to another individual opportunity perspective, rather than looking at the macro and saying, right, this all looks crazy, whatever. You just let the opportunities come to you, no matter what's going on in the big picture, right?
Yeah. And look, I think that's one of the the attractive things to me that really attracted me to this sector has always been, these are very idiosyncratic things, right? Like, whether I make money on investment XYZ that I'm doing now doesn't depend on where the S&P is, right? And I think in certain circumstances, like you're gonna have some correlation. Of course, the correlation is never zero. Uh, but you can really construct a portfolio around very distinct events rather than the market being buoyant, which I've always liked about it. It's always been a little bit more tangible to me in terms of what I'm investing in. So if you contrast that with what's going on in the equity market now, how are you valuing Tesla, for example? You've got to put such a significant high probability on these robots that Elon Musk is building being a huge success. I don't know. I'm not smart enough. I'm not deep enough in that industry to know whether those robots are going to be what he expects them to be. Look, he's a smart guy, and I'll give him some credit. But but I just don't know. It's different than in me investing in something that's backed by a building in New York City that I can say, I think that building is worth 400 million. I'm investing in the building at 200 million. I like that trade. Where you have a significant level of comfort beyond what the market value is telling you the underlyings are worth. So that's one of the things that's always attracted me to this type of investing.
And so when you do invest in this way, do you have a certain time frame, or like, for example, if you were to say, right, I'm going to give this a year or two and see what happens, and then do you have to then pull out of that if it's not worked and put it somewhere else, or can you just leave it for a duration until it goes either the way you expected, or you get forced to exit for other reasons, perhaps if it goes below a certain level?
Sure. So like a lot of those questions will depend on what money you're investing, right? So when I was working at Bank of America, it was Bank of America's capital. It was balance sheet capital. It wasn't a fund that had a fixed maturity date. So theoretically, I could invest in things that had very, very long maturities, right? I didn't, but I could have. Contrast that to my time at some funds where you can't really invest beyond the duration of your fund, right? So if you have a fund that matures in 2 years, you can't really put on 5-year investments, right? So a lot of that is dictated by by the structure of their money that you're investing. Practically speaking, what I try to do is construct portfolios that have very distinct events, right? And I tend to try to limit the duration of those events to be the shortest that I can. But like I would love to have a portfolio of 1-year investments that yield 15%. Those are wonderful types of investments. I think that saves you in a market where there's a significant downturn, and the rest of every other market, equities, commodities, whatever, trades down 20%, right? So I like to do that. I like to run very diversified portfolios. I like to limit my duration. That's not the same approach that a lot of people have. A lot of people like to run very concentrated portfolios. They like to put the majority of their investments in something like Lehman, because they're very confident in what they know, and they think it's the greatest investment. So it's okay. It's personal preference about how people do things. I just choose to dial down the risk and make money a lot of different ways rather than putting all my eggs in one basket.
So would it be a misconception to think that the way you're investing is far riskier than, say, I'm going to say inverted commas, normal investing, whatever you would class that as, which is difficult to define?
I think when people hear the word distressed debt, right, I think they say, oh, geez, that sounds risky. I think that's most people's first reaction. The way I think about it is that it's less risky. It's much less risky. So, using the example of a real estate, like, here's a loan on a piece of real estate in New York City. I've high confidence that building is worth $400 million. I'm investing where the building only has to be worth $200 million, right? For me to make my return.
It sounds like value investing in some ways.
I was just going to say exactly the same thing. It sounds like you've got margin of safety. So it's much more like bond value investing.
Exactly, right? And I think that's much less risky than a lot of other types of investing. There's a lot of discussion right now about the direct lending market. There've been a couple bankruptcies in the U.S. That have caught a lot of people's attention, and people think that space is relatively crowded. Sometimes I do think some of those investments are riskier than some of the things that we do in credit or opportunities or distressed debt investing. You're lending at par, so you don't have a discount to market value or intrinsic value. there's a lot of faith you're taking in a business model, existing as it does for 5 years. Sometimes I feel some of those things are more risky. I mean, is investing in Tesla now more risky than the situation that I described, where something's worth 400 million and it only has to be worth 200 million for me to make my money? I think so. I think Tesla's more risky.
Yeah, there's risk there's risk everywhere, isn't there? It just depends how levered you are, your timing. There's so many things, which is why I absolutely love this whole thing, this whole area of markets and investing and etc. And what's really interesting to see people doing it in different ways and why and how they've got into their particular area of expertise. But it's I'm just trying to think of, like, for example, the people who might be listening to this podcast and thinking, well, how do I get into this, or how should I get into this? Is this something that you think the average sort of intelligent investor could do themselves, or do you think that they should be investing via, say, your own fund or a typical fund in this space that kind of does it every day?
So a couple of things. First of all, I think it's very difficult to do as a retail investor, right? I think there's some large family offices that do it themselves, where they have specific experts that that are focused on the area, but not many. A lot of those guys tend to invest through funds, right? Some of the funds I mentioned earlier, for example. That's pretty much the main way to do it. There isn't really a distressed debt ETF per se, right? For the retail investor. So,
not yet, anyway.
Not yet. Maybe.
There's quite a few US Treasury bond ETFs, and they'll be distressed soon.
Could be, or California at least, right? So yeah, I think it's largely an institutional type market. So invest through the funds. And look, the guys that do this stuff on a day-to-day basis, they're smart people, right? Like, they're you have to be part lawyer, part accountant, part bond investor. Like, there's a lot of different, and part management consultant, right? To figure out what these businesses actually are. So there's a lot of expertise that goes into it. There, like I said before, there's many different paths. Some people are lawyers, some people are accountants, some people are research analysts, management consultants, that have gotten into this this business. Very, very various paths. When we hired graduates at Bank of America, for example, I mean, a lot of them largely didn't have any relevant experience, right? I think a lot of people come out of university or business schools and believe in the efficient markets theorem, and to get into our business, you quickly have to let that go. So it's a little bit more practical. The expertise required, you don't have to be a quant, right? I think a lot of the stuff we do, you can use a very simple calculator. There's no derivative math. There's no real option math that you need to know, although you can apply it in some cases. It's really more about, like I said before, about FTX, blocking and tackling, getting information, evaluating that information, real core, problem solving skills rather than anything else, which is good because it's kind of open to a lot of different people.
Yeah, that's I've got to be honest, it doesn't sound like something. I mean, I love a challenge, but for me, I'm very technical focused. So I'd be quite happy to watch a chart of debt going down and then watch it go back up again and then think, well, that looks like it's based. I might jump on it. But doing and having a kind of overview of...
Sounds a bit too much like hard work.
But having I like the idea of thinking about companies that might do well and looking at the technological changes, like the one for example, we talked about, which is fascinating in the car industry and the taxi industry, and perhaps even the long haul, thinking more about that, how goods are transported by rail and by road and how that could all change. So if you're a long distance lorry driver or something like that, maybe start thinking about doing something else. But aside from that, it really does seem like a long-term intellectual exercise that you've got to be really good at, almost like a lawyer, I would say, to work out and to kind of stick with. And I guess there's another potential problem, I suppose, that you could be doing a load of research only to say this isn't really going to be a workable deal, and so you've got time invested in something that you end up not investing in, which is you learn something every time, don't you? So I guess it's never really wasted, but
Yep.
you still need to make money.
Yep, that's true. I think the one difference between this space and some other parts of investing, right? I think, no matter what part of invest, whether you're in equities, credit, whatever, real estate, etc. Everyone's a research analyst, right? So you have to deal with the things that you were just mentioning, right? What's going on in the industry, is there change, how do valuations work, etc., etc. I think in those industries, a lot of the businesses stay the same, right? So if you're a research analyst, for example, at Goldman Sachs or Morgan Stanley, and you cover the S&P 500 chemical sector, for example, a lot of the companies that you're going to deal with over your career are going to be the same. It's going to be Dow Chemical, and guys like that. I don't know the chemicals business well. In distressed debt, businesses are only distressed for a certain amount of time. They get distressed, and then they either liquidate, get sold, or they recapitalize and go back into the performing universe, right? So, from that perspective, a lot of times the hit ratio is different. It's a different way to think about things. You're always looking at new things, right? It's never the same industries over and over and over again. Never the same companies over and over and over again. So, that's a good thing and a bad thing. Well, it's good because it's always different. Every day at work is different. Every year at work is different. It's a negative because every year is different. You don't have 5 years of experience with a company or a management team or something like that. So you got to recreate the wheel a lot of different times. But look, there are similarities. Like a lot of the best investments that we did probably 2 or 3 years after we first saw them. Emerging into kind of our space of, this thing's getting stressed. What do we think about it? Do we take a first look at it and say, "Ooh, man, that actually is really in trouble." So like, it's way too early. Let's figure out where it goes. And here's the list of things that we need to address in order to get comfortable with making an investment. And, sometimes that list is extremely long, right? If you take the FTX example that I mentioned, how many investments did that guy make? I mean, probably hundreds. So, just from a pure execution standpoint, how long does it take to get through those, right? It doesn't take a few days. It's months and months of digging and, and due diligence and, staying after it. But the rewards can be huge, which is cool.
So if the market was to go into a 2007, 2008 type decline in the next sort of 12 months, what would be the first sector you'd be sort of rolling your sleeves up and saying, right, this is the top one that I think will be the best opportunities potentially?
Yeah, I think it's hard to say, but in general, the way I approach it is at any point in the market, right? The way I approach the market is the following: what's the low hanging fruit, right? So what's out there that I can buy today or tomorrow that I know very well and can analyze very easily. And that trades at good value, right? So if you go back to 2008 and 9, there were a lot of, in the credit market, there were a lot of really great companies where their debt just traded at 60 cents because everything traded down, right?
So name a great company that was trading around there at that level.
I think we made a lot of money in General Motors, for example.
Right.
Some of the big financials, the European financials traded at pennies on the dollar. Some of the junior debt. So these are companies that were previously investment grade rated, right? AA rated, BBB plus rated. That all of a sudden, because spreads widened and the equity market traded off 20%, they traded at 60 cents, and we said, oh my God, those are just amazing. There's no way that those values are impaired, right? Because the assets underlying those were worth 5 times what the debt was worth, that kind of thing. So the low hanging fruit is what we always focus on first, and month to month that changes, right? Depending on what happens in the world, what happens in these different companies, but we always focus on that first. And once we exhaust that, we get into the stuff that's a little bit more difficult. Okay, so what's available, or what sectors are kind of topical? Okay, is it real estate right now? No. Is it theaters now? No. Is it automotive suppliers? No. Okay, we go through those different things, and then we get further down the complexity kind of curve in terms of what we're looking at. And that's kind of how we go through it. So if the market just turned over like it did in 2008, that's the exact approach that I would take. All right, what's the low hanging fruit? Let's deal with that first. are those going to be good investments? What's the duration on these investments? What do we think the recovery is going to be? Are they worth investing in? Sometimes it's going to be yes, sometimes it's going to be no. But let's deal with that first, because those are the easiest things to invest in. And then we go down the curve in terms of complexity and stress in different markets, and we kind of deal with it as it comes.
So we're in a crisis when there's lots of low-hanging fruit from your perspective. Would that be fair?
Yeah. Yep. That's absolutely right. So look, I mean, the last real crisis we had was COVID, right? And I can remember being on. I was at Bank of America at that point, and Bank of America research team used to host calls, right? And I remember, I can't remember if it was EasyJet or Ryanair. One of our research analysts was hosting a call, and I was participating on the call. And they said, they kind of went through the capital structure, and they said, there's $2 billion of debt and there's $6 billion of cash on the balance sheet, and the bonds were trading at, I think, in the 50 or 60 cents range, right? And I actually spoke up on the call, which I rarely do because it's a Bank of America research call. And I said, so there's $2 billion of debt, it's trading at 50 cents, and there's $6 billion of cash, right? Yes. Oh my God.
Right. It doesn't take a genius to work out what to do there.
That's low hanging fruit, right? Like, you had to take a view on how much cash was going to get burned over time, because planes weren't going to fly like they were for a while. But we quickly did an analysis and figured out that they weren't going to burn through $6 billion of cash, right? So, that was the low hanging fruit. Yeah. So if you ever hear me on a research call, on something that's previously investment grade, asking questions like that, then
Right. Great stuff. So I'm just trying to think, Tim, have you got any more questions? Anything that you want to...
No, I'm good. Thanks.
Okay. So Daniel, was there anything that we should have asked you that we haven't, or anything that you wanted to talk about that we haven't mentioned so far?
No, I think it's been a great call. We covered a lot of things, right? I think for people that are interested in getting into this market, younger kids and things like that, there's a lot of people in the industry that are really nice guys and are willing to help. And I encourage people to reach out to me if they want to, and I can point them in the right direction.
Well, you read my mind there, because I was just about to ask if somebody wanted to get into it, how would they do it? So I guess when we share details, perhaps they could contact you. Would that be okay?
Yeah, happy to try to help.
Yeah.
I can't hire the whole universe, right? But I'm happy to try to help and give advice. And people in college and university that are thinking about different tracks. I mean, look, there will be another financial crisis at some point. I don't know when it's going to be. The world feels pretty scary in some jurisdictions right now, i.e. Venezuela and places like that. So you never know.
London doesn't feel that peachy to me, and maybe Paul as well.
That's fair. Yeah. So so there will be another time where distressed debt investing is really back in vogue, and it'll be an amazing time. Hopefully it's not as deep as we saw with Lehman. That's a pretty scary time for everybody, and people's lives changed and things like that, which we don't really wish on anybody. But in terms of investing, there will be things to do, and it could be just significant stress in certain sectors. If AI doesn't turn out to be what everyone's hyping it up to be, there'll be a lot of stress there in data centers and things like that, and energy and stuff, and that'll be fun to pick through.
Yeah. And for anyone who's thinking about the ethics of this, it's the other side of it is that companies that go in to invest in companies that are distressed are actually, they're there to form a market which helps things turn around. Because if there wasn't that buying, things would just go down much quicker. But, everyone's got their own opinion. Like, people don't like short sellers and et cetera, et cetera. But that's the nature of being in a capitalist system. It's like,
that's just the market.
Exactly.
Okay.
It's just the market. It's not personal.
I do think one thing that's interesting about the short selling industry, there's a couple guys who've closed their funds recently, I think, right? And what that means to me is that they're probably giving up a little bit because it hasn't been a good environment. That's probably a leading indicator.
Oh yeah, definitely. And actually, you made a really good point about Venezuela that made me think: do you look at other countries, or How far outside of the US and say are you UK based, by the way? Are you US based?
I'm London based. Yeah.
Yeah. Okay. I thought you said that. Yeah. So you're UK based, but obviously, you cut your teeth in America, so you know that market very well. So UK, US, I'm guessing is you kind of your main markets. Do you go outside of that?
No, I mean, all of continental Europe, is where I've done a lot of business. We've gone into the Middle East a little bit.
Okay.
Look, Asia for, I haven't specifically spent a lot of time investing in Asia. I think it's been a real mixed bag for people. For example, I think, a lot of people piled into India going back, 6 or 7 years, and probably didn't turn out as well as people anticipated. I think all the distress in Chinese real estate has proven to be quite difficult for people. So you got to be careful when you're getting into different jurisdictions and make sure you know what's really going on.
Because you may be dealing with completely different legal structures as well, different legal systems
and political systems, right? So, even if the law says one thing, it doesn't necessarily mean it's going to be the case in some jurisdictions.
Right.
But look, the U.S. and Europe are the biggest, credit markets in the world, right? So that's where you're going to find the majority of your opportunities anyway. So yeah. I don't think there's a real need to go into, very small markets at this point.
Brilliant. So I think it's time for media picks then, Tim. What have you got for us?
I'm going to change gear a little bit because we haven't really talked about sort of cultural things so much in this interview today. But there's I don't know if the name Yuri Bezmenov means anything to either of you two gentlemen.
No,
not to me, Tim.
But Yuri Bezmenov was a Russian, Soviet KGB operative who defected to the States in the early 70s via India. So the story of his escape is itself quite fascinating. And the name G. Edward Griffin may be familiar to you because G. Edward Griffin read a book called The Creature from Jekyll Island, which is about the history of the Federal Reserve. The founding of the Federal Reserve. And on YouTube, it's called The 4 Stages of Ideological Subversion. G. Edward Griffin interviewed Yuri Bezmenov on US television in 1984 of all years. And Bezmenov gives basically a textbook level discussion about how basically the Soviet system was used to demoralize people in Soviet Russia. And to get the measure of this interview, which is only about an hour long, if that, here's an anonymized review on YouTube. As I come back to this video every few years, I've come to the conclusion this may be the greatest interview ever recorded.
Wow.
So, and I say this specifically because it says we haven't really touched on the cultural aspects of things, but I have deep misgivings about the direction of travel in politics in particularly Europe and notably the UK, which is because I live here. And a more cynical person might suggest that some of the things that are happening at a political level are happening not by accident, but by design. And the fact that our current Prime Minister, Keir Starmer, visited a Czechoslovak Soviet work camp when he was in his early 20s, I find interesting.
Do you know the name?
It's the interview with Yuri Bezmenov, and I'll send we can send the link in the show notes.
Do you know the word robot with all this AI stuff and robot? Do you know it comes from the Czech and Slovak language for work? Their name for work is roboty, and that's where it comes from.
And history's kind of come full circle with AI now, I guess.
Yes, it has. It's yeah. No, that's I don't have one that's quite as powerful as that, Tim. I've just got like a series I quite enjoyed on.
I did say it was a change of gear.
No, it's great. It's brilliant. No, fantastic. I mean, I can't wait to watch that. So mine, I had a couple really. I mean, one that I really enjoyed on Apple TV was, the classic kind of hero type film, a bit like the latest Top Gun film was F1 with Brad Pitt on Apple TV. It's just great, good entertainment, really, really good fun. I like F1, and it was just a good classic story and nice entertainment. But there was also another series that was written by or co-written by the guy who created the series Breaking Bad and Better Call Saul. Vince Gilligan, yeah. So he came up with an idea and then got a team of writers to help him out. So I don't think it's pure Vince Gilligan, but it is a great idea. It's called Pluribus. And I started watching it and I thought, this is a great idea. This is really well executed, but I don't really dig the story that much. So I have mixed feelings about it. So I think for some people it's going to be great. I don't think it's better than anything that he's done before, because that was pure him and his story. But I think it's a great idea for a series, and it's basically this virus that kind of takes over the whole world, apart from like a few people, like 13 people, and it turns everyone into a hive mind apart from these 12 people. And it's those 12 people, and particularly one main character, and how she's actually not a very nice person. She's a bit like a Karen, but it's kind of her job. It's become her job to save the world. And so it's a very, very interesting perspective. It's a very, very interesting idea. And there's some great episodes in there. But I just think as a whole story, I'm not sure it was as powerful as anything else. But
do you know where Vince Gilligan cut his teeth as a writer?
No, I don't actually.
X-Files.
Really? Oh, yeah. Wow. That's a good piece of knowledge to know. I didn't know that. Anyway, I think he's a genius. I don't know if you agree, but he's. You've seen Better Call Saul, right?
I think it's superb.
Yeah, it's just so good.
Breaking Bad is one of the best series I've seen.
Exactly, like some of the best TV you're ever going to watch. So, of course, the checkbooks got open for anything that he was involved with. But I thought it was quite interesting that he said, I came up with this idea and then I got a team of writers. And to me, it looks like a team of writers have got their fingers in it. And with that, you do get some brilliant plot lines, but you also see how it gets fudged a little bit and loses its way in some places. So anyway, so I really enjoyed F1. I think that's a fantastic thing to, chill out to. And Pluribus is a possibility, to give that a go. So, so Daniel, what would you have for us? You've got a choice between something quite heavyweight.
I'll kind of come back to maybe a little bit towards the topic. That we were talking about. So I mentioned this book earlier, Going Infinite. So that's about the FTX bankruptcy.
Yeah.
Michael Lewis book, definitely a good read. I mean, Michael Lewis books are always easy to read, and quite interesting story about this guy Sam. That's very good. I think the other investment book that I've read recently that I thought was very good was called The Humble Investor.
Oh right, okay.
It's probably a couple of years old now, but not very old. Very interesting, very very kind of definitely an alternative opinion about kind of a lot of things that are widely accepted right now in the investing market about private equity and things like that. So, so worth a read. And then I've got two teenagers, and I'm trying to figure out how to teach them about finance a little bit and about what's going on in the world with in the UK and the US with government spending and things like that. And I've quite enjoyed a lot of the material that Ray Dalio has put together.
Yeah. Yeah.
He's got a lot of different formats. I read the book recently that is how countries go broke, which is is very descriptive. It's a little bit dense for a teenager, I would say, but there's also videos on the internet that kind of truncate it into easily TikTokable type videos for kids, and I think that's I think those are well worth some time for sure.
I'd highly recommend a book for your kids by a guy who's written a book called Investing Through the Looking Glass by Tim Price.
Okay.
Don't believe a word of it. It's rubbish.
No, it's seriously absolutely fantastic book, and I'm sure they will absolutely love it. It's brilliantly written.
And in an interesting bit of cross pollination, we had a podcast we did earlier today with a gentleman called Andrew Craig. And Andrew Craig has done a lot of relatively short form pieces on YouTube about finance for effectively finance for millennials.
Yes.
So if your kids are looking for something, then he may be definitely worth a visit.
Yeah, he's got a YouTube channel that I haven't got the link right in front of me.
I think it's Plain English Finance and Andrew Craig, I think is the title. Because increasingly we find that we get drawn like into a black hole of the topic of financial education on these chats, and the topic just refuses to go away.
Right. Cool. All right. Well, I'll add that to my list for my kids. I'm sure they'll be happy.
Fantastic. Well, Daniel, it's been an absolute pleasure. And before you go, please let us know where people can contact you. Give us all your handles or anything that you want to share with the audience.
Easiest way is LinkedIn. Daniel Bird, Thornwood Capital. I do have a website, thornwoodcap.com. Either one of those, you can reach out to me, but LinkedIn is the best way. Yeah.
So, sometimes people are in the car or like out listening while they're out walking. So just spell that out
on LinkedIn. Thornwood Cap, THORNWOOD Cap, CAP.com.
Brilliant, fantastic. And do you do any of the socials, X or anything like that?
No, those are the best.
Those are the best links.
Yeah. But I encourage people to use LinkedIn.
Fantastic. I wish you all the best with upcoming opportunities.
Thank you very much, guys. Appreciate your time.
Thank you, Daniel.
Cheers, Daniel.
Okay.
Bye.
Take care.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.